Mpact has more than tripled its full-year headline earnings per share to 187.5 cents. Revenue came in 11% higher at 6.8 billion rand. That's with the exclusion of the paperlink business. Mpact sold paperlink at the end of March last year. The group expects consumer demand to remain subdued in South Africa, and it also anticipates upward pressure on input costs. Joining me to unpack the numbers now is Mpact CEO Bruce Strong. Bruce, thanks so much for joining us today.
Thank you for having me.
Well, let's go through some of the headline figures here. Revenue up 10.9%. Basic underlying earnings per share increasing to 191.9 cents as well. Take us through how you're managing to achieve this right now, because certainly impressive when you're looking at it on a headline basis.
Well, thanks very much for the opportunity. If we look at the year gone by, I mean, you mentioned the subdued GDP growth, which we expect to go forward. It's been there for the last year. Pressure on costs has been there the last year. We benefited to a large extent last year from the weakening of the rand on the one hand, which we saw a 13% weakening versus the prior year period. And in our business, that meant we saw an increase in volumes of paper products sold into the market that were previously exported, so we benefited from that. In addition, we also saw quite a substantial increase in export of fruits from South Africa last year, which are up around 7% on average. And we sell the packaging to that sector, so we benefited from that. And you know, that was on the back of, on the one hand, improved yields in the fruit sector, but also better prices received in rand terms. So we are the beneficiaries of those two fundamentals last year. In addition to that, we managed to optimize, in many cases, the costs upstream of our business. So, for example, on the waste paper side, you know, we've got a substantial waste paper collection business in South Africa, where we account for 45% of all waste paper collected and processed in the country. We are able to, through many optimization initiatives, realize substantial savings there, and that helped us. And that really arose out of our view early last year that it would be very difficult to get prices up to the extent that was required to cover some of those cost increases. And we realized then that we really have to go back into the supply chain and not just push price down, but actually look for opportunities to optimize the entire supply chain. So in waste paper collection, for example, you'll see a number of trucks traveling around most of the major metropolitan areas. We've had to look at the routes that they follow. We've had to look at the nature of the collections. We've had to look at who we collect from and what we collect. And through a number of those interventions, I've explained waste paper. That's obviously a big cost into our business because we use that to produce the paper that's used to produce the boxes. Through a number of interventions of a similar nature, we've managed to maintain our margin in the paper business at around 11.2%, which is good, and grow our margin in our plastics business, which has seen overall a slight increase, or in fact an increase in margins up to 8.6%.
I asked this question to Pierre van Tonder, CEO of Spur, a little earlier. What's your assessment of the pricing power that you have right now, given the kind of market you're catering to, bearing in mind those demand-supply dynamics, but then also taking the cost factor into consideration?
Yeah, there's no doubt that there's a big challenge on the front end in terms of pricing. We're seeing consumer spending under pressure, both in terms of growth and in terms of what people have got to spend. But despite that, there are still people spending in South Africa, and a lot of them are spending locally, you know, as we've seen the rand weaken, for example. And it's not to say our entire business is dependent on the rand, I must make that clear. But we have seen a move towards local products, which is good for our business. And while there is a fair amount of pessimism, I mean, there's a number of things to be optimistic about, even in this environment, you know. So we are focused on the sectors of plastic packaging and paper packaging. We're experts in those areas, and we'll continue to look for opportunities in those areas where we can bring value, and through bringing that value, offer our customers a good deal, and on that basis grow our business and also maintain the margins. I think the other thing which is to be borne in mind when one is looking at margins and prices in a market, and that is that in the absence of innovation, price can only go down. And so we are constantly looking at opportunities to innovate within our business, offer something new to the market, both to promote brands, to bring a security of transport to products, and also to present those products well. And through those initiatives, I think it's not only about cost cutting, it's about finding new products which bring new value to our customers.
Where those investments are looking to be made then in making this company or making sure the company stays innovative moving forward, let's take a look at the kind of gearing you're looking at, because we've seen gearing ratio dropping to 29%. That's down from 35% at the end of the prior year, and you are deriving benefit of lower financing costs as well. So what room do you have to maneuver there? What kind of capex spend are we looking at moving forward?
Yeah, so if you look at our facilities, we've got facilities up to 2 billion rand. Our current net debt is around 1 billion rand. So if you take, I mean, you've got some move both ways through the year. We've probably got a billion. Did I say million? I meant a billion, of course. We've probably got 500 million rands worth of headroom to use to invest both organically and through acquisition in the business. And that's off our current base, you know, notwithstanding the fact that if there was a need, we could access more. At the moment, we don't believe there is a need, but we believe there are opportunities that we would look to pursue to grow the business both in South Africa. We've spent the last 18 months really exploring opportunities beyond our existing borders and beyond the businesses we already have. Bear in mind, we have 2 businesses in Namibia, 1 in Zimbabwe and 1 in Mozambique. But there are significant opportunities beyond our exports, where we've derived 10% of our revenue from last year in the rest of Africa. And we are diligently working on plans to exploit those opportunities, albeit modest in terms of ambitions, because we have no doubt about the risks and the trials associated with developing a business in the rest of Africa. But we are looking at those opportunities, and we look to pursue those as well as opportunities in the South African market.
Are you looking to become a little bit more aggressive than you've been in the past in pursuing that Africa growth?
The word aggressive is probably not the word I'd use. We are cautious, but we are ambitious. So, and why I wouldn't use the word aggressive is because we're ambitious to grow, but it'll always be measured against giving good value to our shareholders. So we run our business to a ROCE target. Our target is 15% through the cycle. And we must make sure whatever we do is not just about growing the top line, but also about growing the profitability in line with that in future.
Well, we've certainly seen your return on capital employed for the year improving to 16%, and that's above Impact's through the cycle target of 15%. Are you looking at setting the bar a little higher moving forward?
Well, I think there's 2 things to bear in mind there. One is the cost of capital and making sure you actually deliver economic profit and value to your shareholders over time. And so that's the first point, I think, that must be made. The second point is, if you're running at 40% ROCE, you're probably going to be under attack from somebody if you're not innovating. So one has to keep investing in the business, improving the ROCE, of course, through optimization and other things. But I don't think it's necessarily a case of saying, well, our target ROCE is 40%. Our target is to grow the business profitably. And if we can do that with a ROCE of 16%, I think we'd be delivering good value to our shareholders and the other stakeholders in the business. If we can improve that over time, that's also great. But it's against the backdrop of growing the business profitably.